Today, I'm going to build a $10 million portfolio from scratch, the exact way I do it for business owners who have just experienced a liquidity event. So, if you're a business owner who's continuing to grow their business and is approaching an exit, or you're a business owner who's just experienced an exit, this might be the most important video that you watch all year. Why? I've seen the good, the bad, and everywhere in between when it comes to portfolio construction. And in today's video, I'm going to show you the exact problems that I see when a business owner exits and they try to invest that money. And then I'm going to show you exactly how you can invest that money to have financial success in the future post liquidity event. My name is Luke Turner. I am the co founder of Moment Private Wealth, a multifamily office for business owners. So if you think about the people you want to take advice from, it's the people who have actually done it before. And we've done this for business owners who have had exits north of $100 million. Now, when we think about portfolio construction, the way I like to think about it is we're going to start at the 30,000 view. We're going to talk big picture, and we're going to get a little bit more into the weeds, and then we're going to go back up to the big picture. As we think about the big picture, the first thing that we want to start with is what we call goals-based investing. For this example today, we're going to look at real numbers. So what we're looking at on this page are the three buckets that we can break every single asset into. We have our war chest, which is our safest assets. We have our growth strategy, which are going to be our consistent performers in the public market. And we have our aspirational bucket, which are going to be our higher risk, illiquid assets. Typically, those are going to be the shares of your privately held business. So in this example, this is what we typically see for business owners that are coming to us. 80-90% of their money is tied up in that aspirational bucket. So if you look over there at bucket 3, you can see we have $8 million in the aspirational bucket. And typically they pulled some money off the portfolio up until this point, and we have roughly $1 million in our growth strategy. I want you to think about this as money that might be in a brokerage account or a 401k that's invested in the stock market. And then over on the far left-hand side, we have our war chest. We have $1 million that's in cash. And this might be a combination of both personal cash as well as business cash. The key to portfolio construction for business owners is making sure that we are incorporating not only what's happening in your personal life, but also what's happening in the business and including those business assets as part of the portfolio construction. Now, one of the big mistakes that I see get made time and time again in portfolio construction for business owners is that we are not taking into account the $8 million that's sitting in our aspirational bucket. And your financial advisor is sitting across the table from you telling you, we need to diversify out of that business, but we need to start taking that $1 million that's in cash and you start putting it into the stock market. And that might be a yellow flag. But when I think about why we're doing that, because we need to make sure we understand what are the business goals and then what are our personal goals. And remember, for this example, we are making the assumption that we are going to sell that business. So for this client, they've come to us. We've had a lot of conversations. They have that $8 million that's in that aspirational bucket. And the biggest question we are trying to answer is, well, if I sell the business, can I continue living the same lifestyle I'm living right now? And the reality is, if you're a business owner and you sell the one asset that's generating all the income for your personal financial life, you can have a big problem. You don't sell it for enough money that can support your entire financial. And that $1 million question is where we're going to pull the onion back and we're going to get a better handle around how we think about the portfolio construction as a whole. Now, when we think about portfolio construction, one of the biggest things we're always looking at are the worst time periods. Because you as a business owner know there's always going to be another bad thing that happens. Nobody could have predicted COVID. Nobody could have predicted 2008. Nobody could have predicted the tech bubble. But those are all things that happen. And we need to make sure that when we're constructing a portfolio, we're constructing in a way that is going to be able to survive all of these different time events. So what you're looking at on this page is something that we call a lifeboat drill. And you can see up on the top here, we have a $10 million portfolio. This client wants to be able to spend at least $400,000 minimum. And their biggest concern is, well, if I have $10 million, I'm not going to be able to generate $400,000 of income off that portfolio in a sustainable fashion and still maintain growth. So how do we think about the construction of the portfolio to maintain that 400,000? Well, number one, it starts with that downside protection. So on the far right-hand column, what you can see here is the number of years that it took for the market to recover in each of these two time periods. So what we're looking at is the Great Depression, and then we're looking at the 2008 financial crisis. And what you can see is if we look at the 100% equity row, so that's our growth strategy. If we're 100% invested in the stock market, it took 7 years to get from peak to trough all the way back to peak and be in a situation that we didn't have to sell any equities that were down. Now, this could be a big problem if you're spending $400,000 because as you can see, your portfolio was down almost 80%. The same thing happened as it relates to the 2008 financial crisis. It only took 3.5 years for the market to go from peak to trough back to peak, but you were still down 52%. So for that 3-year period, how did you get your $400,000 a year? And that's one of the biggest mistakes I see with business owners is they don't keep enough money in the war chest to be able to sustain these long economic downturns. And then they have to sell equities at a loss. And the reality is that is going to kill your investment return. We need to make sure we're protecting against that. So in this situation, we're saying we need to be somewhere between 3 years and 7 years in our war chest. If you remember that on that last page, that's bucket one, our safest assets. When we look at this education, what we then do is we take this information and we say, okay, how much money could we really spend off a $10 million portfolio? On this page, what you're looking at is what we call guardrails based planning. Now, when we think about guardrails based planning, the key here is that we are trying to optimize for you to be able to spend the most amount of money possible. The reality is, you don't get a gold star for dying with the most amount of money. And I've never seen somebody's balance sheet in a eulogy. We want to make sure that you are utilizing the money that you have as a resource in your life and you're able to spend it freely, both as a good steward, but also making sure that we can optimize and spend the most amount of money possible to fund your financial life. So when we look at this portfolio up here on the left-hand side, you can see we're still looking at a $10 million portfolio. But one thing you might notice is the annual income available right below that is $500,000. What you might be thinking is that right? An annual distribution rate above the standard 4% rule? Well, that's exactly right. And why are we able to use that? Well, traditional financial advisors, they look at the market in a linear fashion. But last time I checked, the market goes up and down every single year. And so this dynamic approach that we take to portfolio management allows you to be able to spend more money off your portfolio. What that means is that in down years, which you can see down here on the bottom left, we're going to be in a situation that we actually have to spend less money off the portfolio. But in good years, which you can see down here on the bottom right, we're actually just able to spend more money off of the portfolio. Now, why is this important for you? Because as a business owner, you know that life is not linear and your portfolio is not going to be linear. And it's going to be the first time that you're going to have a significant amount of money outside of your business that's invested in the market. You're able to log in on a computer screen and you're able to see it go up and down. So when the market goes down 10, 20, 30%, you might be down millions and millions of dollars. We need to make sure we are protecting the downside and constructing the portfolio in the right way. So if you think about those last two pages that we just walked through, they're purely education. Now, how do we actually take that education and actually put it into a portfolio? What you're looking at here is something we call a income segmentation. And what we're trying to do is making sure that we have enough money set aside in our war chest to protect for all those downside scenarios. So in this situation for this client that had a $10 million portfolio, we have broken this portfolio down into 4 buckets. On the left-hand side is our most conservative assets. All the way up into the right-hand side are going to be our most aggressive assets. So in segment 1, we always want to make sure we're keeping at least 1 year's worth of cash set aside. So you can see we have $400,000 that's going to be sitting in our trust account. And then we have roughly $1.6 million in municipal bonds. One important factor to be thinking about whenever we're constructing a portfolio is that there are a number of different types of investments that you could invest in. We want to make sure we're investing in the most tax efficient investments. For the business owners that we work with, they're oftentimes going to still be in the highest tax bracket. Municipal bonds is a way for you to be able to actually generate a higher after tax rate of return than things like a money market or bonds. So make sure that you're thinking about the after tax yield on your investments, especially if you're invested in taxable accounts in your trust. Well, what you'll find here is we have $1.6 million that's going to be in that asset class. Now, that $1.6 million is not something we pulled out of thin air. The reason why we have that $1.6 million is we have at least $2 million set aside in our war chest. Now, that's $400,000 that we're spending a year times 5, which gives us our $2 million that we're going to have in segment 1. The same thing in segment 2. We want to have roughly $2 million in that segment, but it's more of a moderate investment approach. We're going to dial up the amount of income that we're trying to generate. Oftentimes in this type of investment scenario, we're going to see us using things like preferred securities, covered calls, or potentially private credit. All asset classes that generate a higher amount of interest in dividends than something like bonds would, but we don't have the full equity exposure and the full market downturn that you might experience. Now, one key thing we need to be thinking about from a tax perspective is too many people take these types of investments and they put them in their taxable account. Things like private credit that earn 9 to 10%. Well, that 10% gets quickly cut down to 6% as it gets taxed at ordinary income rates. But it could be a superpower if you're putting it into tax deferred accounts like a 401k or an IRA, because you're not going to pay any taxes along the way on that 10% rate of return. That same thing can be said for preferred securities and covered calls. They're typically very tax inefficient vehicles, but they can be great tools to use in that second segment. We're trying to dial up the income. We want to do it in a very tax efficient manner. In segment 3, we're going to start dialing up the exposure to the equity markets or the stock markets, but we're going to do it in a very, very tax efficient manner. there are ways that we are going to be able to invest money into the stock market. We're actually going to be able to generate paper losses. And that business exit that you have, we're going to be able to save you tens of thousands, if not hundreds of thousands of dollars on your tax liability. This can be a huge tax savings that many financial advisors don't even know exist for high net worth and ultra high net worth families. This will typically allow you to save roughly 1 to 2% of the account value in taxes in that first year that you deploy that money into equities. So in this situation where we're talking about $3 million, we're going to be talking about somewhere between $60,000 to $100,000 in taxes that we could save with this type of strategy. So make sure if you've had that business exit, you're being very mindful about how you're investing into the stock market. And you're doing it in a very tax efficient manner. That's going to save you money on your exit taxes. And then the last bucket here is going to be segment 4, which is going to be our aspirational bucket, or is going to be in private equity or typically venture capital. Now, the biggest mistake I see financial advisors make when they're constructing a portfolio is they say, we're going to have 20 to 30% in alternative assets. So once you have that business exit, we're going to deploy it all in 1 year. Now, let me give you private real estate as an example. This would be something that would be an aspirational bucket in segment 4, most aggressive assets. If you sold a business in 2007 and you deployed all of that money in 2008, you'd have terrible investment returns in private real estate. Now, is private real estate a bad asset class? Absolutely not. But you invested all at the wrong time. So specifically for that aspirational bucket, segment 4, we're in our most aggressive illiquid assets. We need to be doing that typically over 5 to 7 years. And we call those vintages in private markets, where we want to make sure we get exposure to different vintages of the private equity market, venture capital market, potentially private real estate. So if you've just sold your business, don't make that one mistake where you're going to deploy all your alternative assets in one fund in 1 year. Now, we've gone through a deep dive of how we would actually construct the portfolio. Let's go all the way back to 30,000 view and look at how this plays out in that goals-based investing context. In our war chest, we're typically going to see roughly $2 million. In our growth strategy, we're going to have roughly $5 million. And we're going to have $3 million into that aspirational bucket, which is typically going to be our private assets. Now, if you got to the end of this video and you're thinking, Luke, you covered a lot. What are my takeaways? Well, let me leave you with this. If you're a business owner that's in this situation, the number one thing that you have to be mindful of is making sure that you have enough money in your war chest so you can weather the storms. The reality is the stock market is very much like business. There are going to be storms that come that we cannot predict. And the number one mistake that we have to avoid is getting out of the game. We got to make sure we stay in the game long enough so our money can continue to compound. And the second piece is making sure we are taking a dynamic approach to how we take money off the portfolio. Too many people have a linear mindset when they take money off the portfolio. And what that means for you is you're going to have more anxiety around the portfolio and you're going to take less money off the portfolio. So make sure you're taking that dynamic approach to pulling money off the portfolio so you can spend more money off the portfolio and live your best financial life. And the third piece I would leave you with is make sure you're deploying the right amount of money into private assets, because they are very important to invest in, but do not do it all at once. You need to do it over time in those different vintages. And if you got to the end of this video and you're thinking, Luke, I'm approaching an exit, or maybe I've already had an exit and I would really love to talk through how my portfolio is allocated right now. Well, in the comments below, there is a link to schedule a meeting with me where I'd be happy to walk through the portfolio that you had today. And if you're optimizing for all the things that we've talked about. If you haven't already, please subscribe to the channel. We're going to be putting out more and more videos just like